Welcome back to our 45th edition. 45, yeah. 45th edition of our weekly Wook and Review broadcast. I'm Wook Capital Management Managing Director Rod Altman. I am going to get a disclaimer out of the way before we get started here. After I read that, I'll just kind of run through some FYIs and then we'll jump into the content and we'll go through the discussion. So, Wook Capital Management Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any actions you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. So, just for people's awareness, if you're joining us live, you can follow my screen along. Hello, waving to anyone who's active in the GME DD Discord stage. You can access the Discord server through typing wook, wook.gg into your browser. And if you're not already a server member, I'll be sharing my screen as we walk through some of the discussion topics live. Obviously, for catching this replay, you'll be able to see it all. So, with that said, let me bring up the newsletter that Joe put together for us. It is our 45th, so we're just trucking along. Pun, I guess, intended, since we'll talk a little bit about yellow and labor. I know we talked about them a couple times earlier in the week. We talked about labor, I think, for a couple weeks now, but it's still, I think, a pretty hot topic. You've got another potential labor disruption coming up in about a month here with regard to the United Auto Workers agreements that I believe the contract expires the 13th or 14th of September. So, okay. Yeah, we've got, I'll go through the prepared material in the newsletter. Again, you can access that. I think, Joe, you have it pinned here in the spaces so people can access the tweet thread. And if you're not getting the emails, the link to receive those is in the handle, in the @Wook Capital handle. So we mentioned that, I think we talked about it in the open mic on Wednesday. I don't want to belabor it too much, but you had an abrupt, I don't know what if the term is firing or resignation. I think the formal language in the 8K was that he stepped down, but Tesla's chief financial officer and, quote, master of coin, unquote, is leaving the company. It was not something that appeared to have been planned out. It's unclear the precise reasons why, but a big shakeup over there in Tesla land. Yeah, I'll leave it at that. Moving on. Remote work. So it was funny to see an article early this week or last week, whenever it was, around Zoom, and I touched on some of this on Wednesday also, so I don't want to be too repetitive, but you had Zoom, the video conferencing software company that is the latest company to embrace the return to the office. So they want teams in the office at least 2 days a week, which is kind of funny because they're a video conferencing company. But it's definitely kind of dovetailing with what we can talk about on the labor side. It's definitely a very interesting dynamic going on here with various companies looking to ensure that they're appropriately utilizing their office space assets. I had mentioned on Wednesday that I know someone at a large financial institution who, they're just not seeing the natural rate of attrition that they wanted to see. I haven't seen extensive literature on it. I saw someone tweeting about it earlier today that the attrition rate for companies in remote positions is markedly lower than the attrition rate for kind of typical work or office work. So that financial institution has found that they're not realizing the necessary rates of natural attrition to achieve their headcount targets. So they are cracking down as well on return to office and the requirements that the employees be in the office, at least 3 days a week, regardless of, say, if they took vacation or if there was holiday time, that they would be required to come in 3 days a week. And I think it's likely true for them as well as many others, I'm sure, that people like the remote work jobs, evidenced by the purported lower rates of attrition. But that's something that if you're a big company with hundreds of thousands of employees and you model out teens or 20 or whatever your natural rate of turnover from people leaving, et cetera, is, if that rate drops a lot, right now you're just going to be overstaffed. And if you're looking to avoid layoffs or firings, right, where then you may, as the company, be on the hook for paying, the unemployment insurance claims. It's interesting seeing this lever that companies appear to be pulling, which is the more stringent return to office. We've had this discussion before, and from the research I've seen, it's mixed in terms of what are the productivity impacts of work from home. I would add, I have heard anecdotally that at least in situations like the one I was referring to, when employees are forced back into the office, at maybe higher frequencies than they would prefer, that then you kind of get where employees do the bare minimum, where that they see their in-office productivity decline. So it's a delicate balancing act, and it's just very interesting as we continue to normalize post-pandemic in terms of what is the right mix of hybrid versus all on-site versus full remote. And just thinking about some of the challenges that it's throwing in. So we can touch on that. Happy to have a deeper discussion on that. Let me just get through the other two items here in the newsletter. This was a story out, I think it was, Wall Street Journal earlier this week, or maybe it was last week, referring to the really just record level, very high level of short covering across kind of the hedge fund space over the last 2 months. So from Goldman Sachs Prime Brokerage desk, the cumulative dollar amount of short covering by hedge funds in June and July was the largest over any 2-month period since 2016. So, there was a lot of absolute dog shit, for lack of a better word, that ran up a lot over the last few months. And it makes a lot of sense in the context of meaningful short covering fueling that rally. Now, the question becomes, how sustainable is a rally like that if it's fueled by short covering? Eventually, that fuel is exhausted, and there will certainly be participants in the market who opt to re-enter their shorts at higher levels, perhaps not the same hedge fund that was covering. But that was obviously a big rally for stocks over the course of the summer. So I think that was an added aspect of it. Obviously, a lot of big losses on short sales year to date. The hedge fund space generally has underperformed meaningfully in terms of compared to the major indices. I haven't looked at, I don't have the data in front of me, but I know that I think the average fund performance year to date was up in like the low single digits, based on HFR data. So that's obviously a big lag relative to how well S&P and the Qs have done year to date. And most of that, from my understanding, is from underperformance on the short side, as opposed to the long side. So a lot of the funds were heavily short, had a lot of leverage on. So they've obviously been delevering by this covering that's been at extreme levels over the preceding couple months. So it will be interesting as summer vacations draw to a close here in a few weeks. As people come back and you kind of start to maybe see more volumes return to the market, perhaps we'll see prices revert, and mean reversion will eventually happen in all likelihood. None of us know precisely when, but just some thoughts on short covering there. And then, yeah, I want to go back to yellow. And I have a bunch of other articles up that we can kind of click through depending on what people want to talk about. If anybody wants to request to speak, please feel free. We'll bring you up. You can chime in. I'll get through this last kind of piece of the prepared material in the newsletter, at least on yellow. So we talked about it a few times. It's just one of those super interesting, peculiar situations. And Monative, I know you're in the audience, and we chatted on Wednesday about it. There's a few updates on it since then. They had taken a debtor in possession, a DIP loan from Apollo as they entered Chapter 11, which had a really high interest rate, 17%. Well, maybe a little lower than the average consumer's credit card interest rate is now. But the kind of updated kind of positioning here is that you have the hedge fund that we talked about, MFN Partners, who had acquired 42.5% of the company for I think it was $23 million, who is also the largest investor in XPO, which is another large less than truckload carrier. So they have offered to loan Yellow the same amount as Apollo, but with lower fees. That's according to Yellow's lawyer. And then you have another rival trucking firm, Estes Express, which is a smaller LTL. They've also floated a proposal to offer up to $230 million at a 2% lower interest rate with lower fees as well. So it was really interesting to just watch this thing as you have interested equity party on the hedge fund side, you have an interested industry competitor, and then of course you have Apollo, who took the lead on the dip initially. So they quote a UPenn law school professor, quote, "The prospect of multiple bids is a good thing in my view, despite the irony that they're funding a business that's completely shutting down." So it's definitely just one of those really interesting situations to monitor. And for me, as someone who's been closely connected to the transportation and logistics space for much of my post MBA professional career, it's going to be interesting to watch how this all plays out. So we'll see what happens. There's definitely, as the Yellow lawyer notes, a once in a lifetime opportunity to secure certain types of these terminal assets, because we're talking about an industry less than truckload where there's a lot of consolidation points. You're trying to do final delivery with the tractor. You might have a small pup trailer on the end. You're doing maybe intra-city stuff. So if you can get into the really built out urban areas where you're really proximate to everything, it can provide you with a competitive advantage from a network management standpoint. So Yellow, as we've talked about, has a lot of those. It's almost a 100-year-old company, incumbent terminals. So, but we will see what ends up happening. The amount of assets versus liabilities, right? The equity equation will be, if there are more assets than there are liabilities, then equity could see a recovery. It looks like it's going to be pretty close. It's still unclear if MFN made the play with an explicit view that they could profit directly off of the Yellow stake, or if it was more of a positioning themselves to be actively involved in the asset sales so as to benefit their largest investment, XPO, which, to be honest, I actually don't know the size of their XPO position, so I should probably look that up real quick if they file a 13F, because that, so they had 12.6 million, I think I just saw, shares. So XPO stock closed today at 73. So yeah, it's that almost $1 billion investment in XPO. So if you think about the 23 million that they've invested here in the Yellow equity ahead of the filing, it's a very inexpensive option for them if it's going to, if they become the dip provider and they can have more control over the proceedings and they're able to perhaps advantage XPO as a buyer or bidder on some of these assets. It's just a really interesting situation. So if anyone has any other insights or comments on it, welcome it. But that's obviously going to play out. That Chapter 11 should go fairly quickly, is my understanding from what I've read. It's not the type of thing they're going to look to resolve within several months. And that's obviously going to involve a lot of industrial real estate sales, as well as equipment sales from the tractors and trailers that the company had in their fleet. So, that,
So
hey, Monadev.
this is, yeah. Hey, good afternoon, Raj. So this is interesting, right? It almost feels like Apollo thought they could just walk away with the assets as the debtor in possession, and now they're being challenged, and this might actually, instead of being fast, this might actually take a little longer as they start marking every asset to market to find, what is the remaining value here. Not saying there is any equity value, but I think, well, yet, right? But I think this is going to take a little bit longer. Apollo, I think, miscalculated here, and trying to get 17%, is more like, it's probably going to accelerate the bankruptcy, losses rather than, I don't know. It seems like now more parties are challenging Apollo's ability to just close this out quickly.
Yeah, for sure. And I know Estes, I think they were on the cusp of top 10, but there's been some consolidation in the industry. So they're a smaller LTL. Um, but the fact that they're also getting involved here, I thought was pretty interesting. I believe they're predominantly located, their network, in the southeast. So they're less of a national network, if I'm remembering correctly. I'm not an expert on them, and I think they're private. Yeah. So they do offer
So does
nationwide coverage. I apologize, but I think they're focused on certain regions more than others.
does Apollo have a big exposure already in competitor?
I hadn't seen that in my reading on this Monative, that Apollo was a big holder. I mean, they could be, but I hadn't caught that. Yeah, in 21, they were the 12th largest for hire carrier in the nation by fleet size. That's Estes, not to be confused with Eppies, which is another one that Penske acquired a couple of years ago. So they are the fifth largest LTL and the largest privately held freight carrier. So they're definitely a large player. They, at least when this was published in Freight Waves, they were debt free, so they likely have some capacity if they were going to use any debt related funding to bid for these assets. So um, yeah, the situation is, I kind of agree with that notion. Apollo seems to have been a little maybe greedy in the terms that they offered to Yellow, thinking that no one else was going to come into the mix, and now you've got the largest private carrier in the country potentially entering the fray, and a very large LTL investing hedge fund entering the fray. So interesting stuff. Um, okay, so just again to kind of recap, it's 4:24. We'll keep this open, up to 6 o'clock. If we exhaust the conversation before then, we'll close it. Went through the prepared material in the newsletter that's pinned. There were a few other stories that I noted that I'll kind of just start walking through some of them. Excuse me. I wanted to mention, because this was something I came across today out of Freight Waves. It was a really good video. It's a 12-minute video from NACFE, which is the North American Council on Freight Efficiency, Fuel Efficiency, Freight Efficiency. And they had done a profile on PepsiCo's site in California that is the first adopter of the still in, I guess, pilot production Tesla Semi. So it's a 12-minute video. I'll just share it in Discord in the stages chat. Joe, maybe you can just, I don't know, pin it or something. But it was a really good video to kind of like help people understand some of the stuff that I like to rattle off about the complexity and the challenges associated with fleet electrification at scale. So Pepsi had done this kind of electrification of this site in, I forget if it's Modesto or what. I'm sorry, I don't know California geography. But they had gotten a ton of money from the Air Resources Board in that area to fund the acquisition of this equipment and to kind of make ready. But there's a couple highlights, I guess. For one, talking about drivers liking it, talking about them being able to use it with a loaded trailer on routes up to 450 miles in length, which I thought was interesting. I think Elon had alluded to 500-mile capacity on the longer range semi, but we still don't have any official data. So kind of hearing some validation from Pepsi is interesting on that. The one thing that I really always emphasize on this is how much more complex the overall system solution is for fleet electrification. While the equipment itself might be simpler, fewer moving parts, lower operating costs, the overall solution complexity rises a lot. And they talked about the learning for PepsiCo being, they'd done, I guess, a partial make ready for the site. They hadn't maybe built out full on the necessary infrastructure upgrades to fully electrify that facility. So they noted in the video that going forward they would do the things kind of all the way from the get-go. But they also noted that it's like an 18 to 24 month planning that you as a fleet, if you're interested in converting to electric, you have to start almost 2 years in advance, going through all of the permitting, going through all of the potential infrastructure upgrades to make it ready for the heavy flow of energy going on. If you have multiple big rigs sucking power, megawatts of energy flow. So, it highlights to me that fleet electrification is going to continue to be something from big corporations that are well capitalized, that are able to tap into grant money, able to tap into kind of managing really complicated overall systems like this. And while it's nice to hear that, it's obviously a little bit of a PR video when you listen to it, but the drivers do like the equipment. That's what I had heard while I was at Ryder, that look, if you're a truck driver sitting in a really loud, whether if it's a cab over engine, you're right on top of the engine. It's a very loud working environment that you're in, for 8 to 10+ hours a day. That having that silence, in terms of the electric motors, that's something they appreciate. You obviously get some benefits from, having faster acceleration, which if you're doing, let's say drayage in like SoCal, being able to deal with the stop start in traffic, it sounds like that's much easier in an electric truck, and it's obviously a better use case for it. But yeah, check out that video. I thought it was cool. I'll keep going. So also this week, NOAA bumped its Atlantic hurricane season predictions up. When they'd come out at the start of the season, they predicted an average season. They've raised their forecast now to an above normal season. And part of that is the ongoing El Nino, which has led to very warm waters in the Atlantic basin. The Gulf is near where I am is always very warm, but it's just extraordinarily warm right now. It's like a bathtub. So the fact that there's more warm sea surface temperatures record warm sea surface temperatures, which also means more moisture in the air, those are the fuel for bigger and stronger hurricanes. What I will watch for this year is if we, which fingers crossed that it doesn't happen, but this ongoing phenomena of the rapid hurricane intensification, where when the hurricanes kind of get into the shallow waters that are just bathtub warm temperature, like in the Gulf, like what happened to the Florida Panhandle a few years ago, where the storm went from, I think went from Category 1 to Category 5 in 24 hours. The rapid intensification is enabled by these really warm temperatures. So there's nothing out there right now. If you go to the National Hurricane Center, I don't think there's any disturbances even in the Atlantic Basin. But seeing the uptick in expectations for an above normal season, not really surprising to me, having heard about all this El Nino effect on water temperatures. So, I know we sadly referred on Wednesday to what happened in Maui, in Lahaina being destroyed, which the storm didn't even hit the island directly. It was the winds from the storm, and a dry season, and unfortunately, most of Lahaina, I think, is gone from the footage I've seen. So hopefully the prediction proves wrong and we don't get an above average season. But look, if you're in the if you're an investor in, say, the refinery space, we're seeing the updated IEA forecast came out this week, and demand is at the highest level ever in terms of demand for just barrels per day. The world is demanding now 103 million barrels per day. So while it was a modest cut from their July estimate, it's still record demand. And you may have supply challenges, as you're always apt to this time of year. If a big storm like that comes through the Gulf and knocks out some refining capacity, then you're probably going to see fuel prices go even higher than they have been going. And I know I've mentioned, I think, PBF Energy before as a refiner. I have, at least on my personal account, investments. It was nice to see that stock make a breakout today, above $50 per share. It closed up below it, but I see Mr. Mile High Stock Guy in the audience, and from what the line he drew on the page, he made it sound like it was a breakout. But seeing how strong RBOB, gasoline has been performing, with demand being higher, right? Any impacts on capacity are going to cause even more potentially violent moves to the upside in energy markets. All right. I want to go back to one thing that I've seen a lot of headline coverage on, and I would point you to freightwaves.com as a great resource if you're ever just trying to stay abreast of the transportation and logistics industry. They offer a lot of great free content. Their CEO put out a note yesterday, which I thought was really interesting, kind of highlighting that there's a lot of work in the physical economy that is going to continue to be needed for a very long time. Craig Fuller kind of wrote this, I think, pretty solid little note about it, just highlighting that truck drivers, farmers, pilots, plumbers, all these kind of manual jobs that, unless Elon is right and Optimus is going to be replacing all of us, there's going to be demand for many years to come. But people keep noting this $170,000 a year number for the UPS drivers. Like, I just want to clarify for the people who are confused about that that's a fully loaded number. So that's not the salary they're being paid. That's the pay plus all the value of all of their health and other benefits at the end of by the end of the 5-year contract period. So that's not what they're getting paid in salary today to drive a tractor for UPS. It's and look, Walmart private fleet, which is one of the largest private fleets in the country. Walmart deals with a lot of third-party carriers. Walmart has its own fleet of, I think they were close to 10,000 drivers last I checked, but they're hiring drivers, and paying a wage of 110,000. So if you think about add 35% to that base pay for all the benefits, it's not anything disproportionate to me. I think it's just surprising. A lot of people don't realize a lot of these these truck driving jobs are actually good paying jobs for these private fleets. And while I see some people on the Twitter app kind of like condescending, like, oh, you only had to go to high school and you're going to get paid 170,000. Well, it's a tough job, and it's not like the guys and gals start at that pay. That's for seasoned drivers who have impeccable safety records. These are men and women putting in millions of miles without an incident over their careers, generally speaking. So, I think just to bring the conversation back to the labor side, right? That this is probably going to be just more and more, right? Like present in the news. And we talked about a couple of weeks ago the film related work stoppages from the striking. I have too many browser tabs open. I was trying to find the odd lots. Odd lots had kind of cited, or rather, one of the odd lots earlier this week was discussing the fact that you have UAW. September 14th was the date that I said earlier. I think it was the 13th, 15th. So it's the 14th where the contract between UAW and the big three car makers expires. And it is very clear that in a tight labor market as we still exist in, that labor feels like it has a lot more power to bargain, a lot more than it did, 15 years ago when some of these contracts were coming up, amid the great global financial crisis, where labor ceded a lot of its power to employers. I think labor is trying to grab that back, and as evidenced by the success that the Teamsters saw with UPS, I imagine UAW is going to really push the big three automakers on this renewal as well. And I would not be surprised to see, if they can't get terms that they're satisfied with, some stoppages. And then look, that flows through to other companies, right? Talking about Ryder. Ryder has a very big automotive logistics business. It's known that General Motors is a customer. If General Motors strikes, that impacts Ryder's business. It impacts a variety of other players across the industry. So like the ripple effects of this sort of big outage could be pretty substantial. I haven't seen it discussed a ton just yet, but this kind of hot labor summer, this phenomena, I don't think is going away. I think labor feels like it's been maybe taken advantage of for a long time, organized labor, and now that it has maybe the ball in its court and has some cards in its hand, so to speak, it's going to play them. And yeah, definitely need to watch this. We avoided disaster if the UPS kind of strike had occurred in conjunction with the failure of Yellow. But yeah, labor, I don't see this going away. This kind of pushback between labor and capital anytime soon. In the another newsletter I recommend is Bloomberg's Odd Lots newsletter. They kind of called this out and referred to some of this stuff. I'll read a little. I have it on the screen about kind of what they pointed out. So the question was, what does labor's leverage mean for wages and inflation? And the response was kind of like, well, okay, citing the UPS agreement, for example, while it may have a negative effect on UPS profit margins, that puts more pressure on non-unionized FedEx, which may lose drivers seeking higher wages elsewhere. So therefore, you think about the effect is to raise wages even for non-unionized workers in the industry. Obviously, in the automotive space, thinking about UAW, you've got the legacy players with their Midwestern, upper Midwestern, more unionized workforces. Even if they do strike or if they do get a favorable agreement, you would think that leads to higher wages for non-unionized automotive workers. Perhaps it does flow through to the southern factories where workers are non-unionized and are paid less. And then the other kind of point of the equation would be on the productivity side. The logic being, if labor is in fact so scarce and thus labor's got more bargaining power in these negotiations, presumably companies will invest even more in productivity enhancing technology. So I think we mentioned last week that the second quarter productivity report had come in and it was above expectations and it was a great read through. But what will happen here? Right? If we start to see more combativeness between capital and labor, you would imagine then you'll have even more investment in seeking automation and seeking ways to get by with less labor from the capital side, getting more productivity out of their existing labor. So obviously there's all these big investments that we've referred to that are showing massive investment in infrastructure and in manufacturing domestically. So that requires though labor, and as we've continued to get good pretty good readings indicating that while the employment market is cooling, it's still pretty tight, near max employment. And yes, inflation's cooling. It's still higher than Fed would like. It's going to be very interesting in the coming months, just to monitor the developments in the labor market and see what, if any, disruptions that causes on the broader economy. And then last I have a couple others, but one other tidbit, not seeing folks request to speak, so I'll just keep rambling until I get interrupted. There's a new Omicron variant dubbed Eris. So I'd seen a lot of people mentioning, an uptick in COVID again. Now, look, obviously the danger of the disease, if you don't have pre-existing conditions, is maybe more comparable to the flu now than what it was however many iterations ago. But just something to be aware of. COVID infections rising again. Probably have that trend continue into the autumn. Think about kids going back to school, moving around, diseases spreading. So you've got a chart here from Health and Human Services showing people in the U.S. hospitalized with COVID. Obviously, it's way down from where it was even at the beginning of the year, but it's begun trending up. Again, hospitalization is probably not going to happen if you're a healthy person, but So just wanted to point out though that there's another kind of strain, and clearly COVID, just like the flu, is now endemic, and it will be with us, and we'll see, I guess, if this spikes further from here. But I did want to call that out. Oh, and news out just before the bell was that Sam Bankman-Fried is getting sent to jail because of his witness tampering. Gotta love it.
Yeah, Rod, and another bit we didn't talk about in the newsletter is WeWork up 100% declaring bankruptcy. Well, not bankruptcy yet, actually, just that they expect to be going out of business.
No, it's just marking to market so they can, show profits overall when ARM sells. Man, they're getting greedy on ARM. Looks like that might work, but God, that business, I never got it. They sign leases at such ridiculously high prices, expecting to, parcel it out on a weekly, monthly basis at even monstrously high rates. It's Singapore. I was there in Singapore when they were going through this, when they were scaling up Singapore. I think it was like 19% of commercial offices they had leases on, and there was a few quarters there where it was all completely empty. These guys, I don't know how it could have been a business in any sense. This was
we got blessed with the term community adjusted EBITDA, though. Without WeWork, we wouldn't have that in the vernacular.
Yeah, I mean, see, this is the problem, right? It's a it's a retail time arbitrage, rather real estate time arbitrage business using a technology platform fronting as a growth company in some sense. It's weird.
It's definitely a ZERP phenomenon. This one.
Yep, yep. There's a bunch of those that need to go out of business.
Yeah, so the 8K on, I guess it was the 8th earlier this week. I don't pay enough attention to all these companies, but they had the going concern language, right? So the company's ability to continue as a going concern is contingent on successful execution of, cutting costs and potentially raising more capital, which is going to be hard to do at 20 cents a share on the equity side, at least. And I'm not sure who would want to buy them or why they would want to buy them when, I mean, what are their assets? It's leases. It's their their assets are also liabilities. Um, so I don't know if Mondative, do you have any idea of, if WeWork shutters, like what potentially commercial real estate impacts that might have?
So present value of future leases on the books might have to be written down by CRE, right? Because those are not going to get paid.
Yep.
So again, this is a large city phenomenon, so it's not going to. It's probably a really big problem in cities like San Francisco, LA, New York, Chicago, more than it is in almost any other city. So this is going to be a specific problem. The weird thing is, if if back to work is happening in fits and starts, you would think that companies would be interested in using, space like this, flex space like this, and giving up on their offices more and more, especially where it comes to, marginal sites, right? Like instead of Google and Facebook, maybe horrible examples, but that's the first thing that came to mind. Having offices in like Boston or Miami, where they have, maybe a larger sales team, but really nothing else. Um, they do, an arrangement with WeWork and just bring in people as, when people have to come in for their 2 days, 3 days, they just come in here instead of. I don't know. It's some. I'm guessing that they all did that calculation of seeing, whether it makes sense to keep leasing the spaces they have versus taking flex space. Maybe this will become a viable business once the other companies are able to get out of their longer term leases.
Yeah, I'm looking at their 10K right now. I was trying to
or
get a sense. I don't know that they break out the properties.
or or the other way to look at it is, if you started a WeWork business today in the depressed, triple net rates, maybe it's a heck of a business going forward.
Right. Maybe they can restructure all of their leases, cut all those costs to the bone, get these favorable current market terms on some of these city center, dense downtown office space, and we could get a WeWork rising like a phoenix from the ashes. Not so sure. But of their 779 locations that they lease per the K, 301 of those are US and Canada. And I would agree, at least my understanding is, like you said, it's the really big kind of prime markets like your New York's, San Fran, Miami. Um, got a chance to go into my first WeWork in Miami Beach, which was a neat little location. But yeah, I think that'll be interesting to see how this plays out. Is this the type of thing that, if they just restructure the cost side where this business could work? Did they just enter into leases at too high of a rate, or is it more structural than that? That this business just doesn't really work? I don't know. Joe, you brought it up. What do you think?
Well, I think it's hilarious. Net worth of what's his name again? I forget his name.
Adam Newman.
Evan Newman. Yes, I knew it was Newman something because I always think about the Newman's Paul Newman, who's way better. But it's insane. His net worth absolutely plummeted. I mean, he was worth what, like 40 billion, and now he's worth not even a billion.
Well, the better question, Joe, is he worth more than we work because he got his payout?
It's true. What was this? His net worth at what point? It was insane. Now, Forbes says 2.2 billion. They're not accurate. That is,
Holy
but
moly. So the 6 month operating cash burn was over $500 million, and their total liquidity was not much more than that. It was 680 million as of June 30th. So, yeah, it makes sense why the going concern filing came out this week. It definitely doesn't look like they're going to get past the end of the year.
yeah, there's no chance. No chance.
Their physical occupancy rates are down, have been trending down over the last few quarters. Not good. But I guess going back to the stock, I mean, the wild thing to me, and this is another example of where too many people just look at the price. Oh, 20 cents. We're still talking about almost $500 million in equity value at 20 cents per share because of how many shares outstanding there are. So this is the type of situation where I don't see how there could be any sort of equity value. You're going to do a restructuring, and old equity would basically, I would think, get wiped out. But who knows? When it gets down to those sort of prices, certain people get interested in them, and it turns into a meme. Who knows where it could go? But yeah, that's just a separate conversation.
Yeah, I'm wondering how much of consideration have they already gotten from the property owners, so they can hide the having to write off the lease altogether by kicking them out. So they probably already well beyond insolvent. I think. Do they have any data on how much mortgage forbearance they've gotten? I'm guessing there will be plenty of real estate owners, CRE owners that are just keeping them afloat and not taking full rent and willing to write off smaller pieces so they don't have to write off the whole lease. I mean, instantly those properties become negative if you take out a tenant the size of in fact they might have whole buildings. So
yeah. And I know that in some of these cases, like the buildings themselves were, the floor plans were very specifically laid out for the type of work, the type of kind of shared and very easy to dole out little office spaces here and there. So
exactly.
it's going to be a very different user than, say, a company who might want the whole floor. Or yeah, you're right. It's going to be a very big headache for these companies that own the real estate.
But Apollo should be going after this. They should be buying up these buildings at 30 cents or 40 cents or whatever they can get on the dollar, and relaunching a WeWork, but rather whatever you call it, right? A flex space company, at these prices here, right?
I think the issue with commercial real estate is a lot of people don't know where the bottom's going to be, and there's so much leverage on a lot of these properties still that it's not an area I'm an expert in at all. But I've got to wonder if people are waiting for it to get uglier first before they want to jump in.
Yeah, but Rod, if you look at the data from, let's say, some of the regionals that are providing a lot of detailed breakdowns in their earnings, the real thing is the leases renewal come up at different times. So, marking it to present value on all of those is the real question. So it's not like many of these will hit the market until we have a black swan where things really go south fast. If we have this slow leak, you could just hide the whole problem for a long time to come, or l- put it out and dribble that it's not going to shake the whole market completely, which helps each other, right? It's like it's like I don't know how to put this. It's in everybody's interest that has ownership to have the least amount of properties come to the market,
Yeah,
because nobody can sell anyway. So they could all be working together to cook the books.
yeah. The longer, yeah, you're right. Ideally, these properties are coming up at a very staggered rate. You don't have a lot of stuff coming to market, and you having to potentially mark down or take crappy lease terms uh, on it all at once. Man, what a horrible. They burnt 646 million uh, in terms of their free cash burn year to date. So yeah, at that rate, it's not looking like they're going to make it through year end with their liquidity. All right. Well, look, it's top of the hour, so we've been at it for about an hour. For those who maybe just joined, we kind of walked through uh, the newsletter, prepared content that Joe had put together for us. That's also pinned. We're now kind of just chatting about whatever topics people want to discuss. We're kind of just touching on some of the major news events of the week. So if you want to speak and chime in, ask a question, feel free to request. We'll bring you up, and we'll go for another hour to the extent people want to keep talking. And otherwise, we can start our weekend if no one wants to chime in. I'm good either way. I will be here. I do have, again, the stages open in the GMEDD Discord. If you go to wook.gg, you can join the server if you're not in there. And I'm sharing my screen as we kind of go through some of this different stuff. So, hey guys, get a little wave from me.
So Freeport McMoran had a cybersecurity breach, and they said it's slightly affecting their output. They didn't go into details. I think those are the weak links in the chain is the level of security we have on industrials, right? If you take financials or tech or healthcare, they're reasonably well secured. So short of either a new security hole or just a mistake on their part, the breach is there while it's a big deal when it happens are fewer and farther in between. But industrials and infrastructure plays, those could be the real problems as we go forward and as we bring more production in house, right, into US. I think these are all incidents that we'll see more and more of on a daily basis.
I see that PR. They say to date, limited impact on production, transitional solutions being planned to secure information as quickly as possible. A prolonged disruption could impact future ops. So yeah, no, that makes sense. I had seen, I think it was just yesterday, I saw it was a school in Michigan or a school system in Michigan whose entire like air conditioning network was being managed by like 30-year-old software on a single computer somewhere. So like all these, I guess, like under investments in technology on some of these physical world companies, you know, there's definitely some weak links, like you noted, that could cause real world troubles.
Yeah, and this is what I was talking about the other day, right? Mandiant, which is the world's premier incident response company, meaning when things break, they're the first ones that get called because they can quickly, shut it all down and then, figure out where it's coming from and hit back and clean up, right? So what's interesting to me is, as you have more and more of these incidents, you're going to have Google employees in there first thing, and you can bet your bottom dollar they're going to be cross-selling cloud. So, this is people don't understand the value of that Mandiant acquisition. I think it's an amazing franchise as long as they can keep Kevin and his team together. This is like the private sector NSA. That's what this is. The depth of knowledge and experience and access that these guys have does not exist in any other company anywhere in the world. So when you have these older line players that are really not big in the cloud but get an incident, they're gonna call their regulator, they're gonna call their their big their competitors, and everybody's gonna say, yep, call Kevin. And Mandiant is gonna get the call, and Mandiant is now Google Cloud. So this is an amazing franchise that they got literally for next to nothing, rounding error, and the fact that it was small enough, it it was not looked at deeply from any antitrust. So this is an amazing purchase by Google.
It's funny.
Again, it's
You
not
know, I
about,
don't follow
yeah,
this
it's
stuff.
not
It
the
was the
money.
first time I'd heard about it when you said it the other day. It's like, oh, 5.4 billion. It's a pretty big acquisition, for many companies. But you're right, for Google, it's like a drop in the bucket.
Yeah, it's not, like I said, right? Most people thought of that, and they said, okay, yeah, it's about couple of $1 billion in revenue. It's not nothing. It's a little over $1 billion in revenue, but it's about the 2390 75, something like that. People with the highest possible security clearance all around the world. That's what this was for. So it's more an acqui-hire than it is a buying revenue, right? So it's exactly events times like this when you're most stressed, and when you really bail somebody out of the deep shit that they've gotten themselves into, you're going to listen to them when they pitch their other products to you.
Oh, totally. That makes a lot of sense. if you're a competitor of Freeport's, you see this news and you're like, oh shit, I don't want that to happen to me. You call them up.
Exactly.
You guys are all shy in the audience. None of you requesting to speak. I guess it must be the Friday-itis. It's August 11th. I guess for some people, I think the kids here in Florida went back to school this week. Traffic was picking up, so I guess some of you folks are enjoying maybe the last of your summer, and I can't blame you. Why you're listening to us ramble on? That's the real question. Oh, Mr. Scott Lowe's, Mr. Lowe's down. Good to hear from you, sir. Happy Friday. You're muted, Scott.
Oh, yeah, I was just going to say happy Friday. I don't really have much to add on these topics, but yeah, I joined late, but always enjoy the insights on other spots in the market that everybody's really tapped into.
Appreciate it. Anything you're seeing in, I know you work professionally in natural gas in the Pacific Northwest. Anything of note that you're observing in the space? And I know, of course, you've done many, many deep dives into kind of the battery recycling side. Of course, you and I got to interview Zarko Maselja, the CEO of Recycleco Battery Materials, a couple of weeks ago, which that replay is available, I think, on your channel, which you're welcome to share with the listeners, as well as Joe. I think it's on our YouTube, the Wook Capital YouTube.
Yeah, I didn't repost it on mine because I think the algorithm for YouTube would have just pulled it down because it's a copy. But yeah, so it's on your guys' channel. But that was a fun chat. But as far as the the natural gas space, it's hard, right? Because when money's cheap and interest rates are super low, everybody wants to go with green technology, spending lots of money to upgrade to solar panels or battery stuff in their house or whatever, heat pumps to switch out furnaces. But once money gets tight, it all comes down to not having the 10 to 20 grand per house to upgrade. So yeah, it's natural gas faces its own unique challenges in the market. I think there's this stigma that natural gas is going to go away in a couple of years. I'm not too worried. I've got.
I don't think it's going to go away even in a couple decades.
No, I fully expect if I choose, I can ride out right to retirement in my current employer, just because the natural gas space is so entrenched. I think.
Well, hasn't then, and it's not a space I'm an expert in, but I have listened to enough of the Canadian oil mafia guys talk about investments in LNG export capacity in that part of Canada. Is that something you're in the know on?
Yeah, actually, I'm kind of starting to get back involved in my previous role. I used to work as an LNG actual operator, and now I'm working kind of on LNG projects. But there is a lot of investment happening for within the utility space that is scaling up LNG facilities, as well as private players within British Columbia specifically looking to export LNG. And I think it's one of those markets that's kind of untapped in terms of marine fueling. I know we, as the utility, work with our actual Trans-Canada highway that runs across Canada. Part of it is covered by the BC Ferries network. And the BC Ferries actually operate a fleet of LNG fueled ferries. So, even just for short little runs, it makes sense. It works, and it's the stepping stone to getting towards lower carbon emissions, right? And in sectors that it's not feasible to run a few megawatt plant just to dump electricity in a battery of a ship to then have no way to refuel it on the other side. So yeah, it's interesting. Yeah.
No, good stuff, Scott. I appreciate it. I know I've seen some of the good graphics that kind of highlight when you talk about seaborne, fueling challenges. Like you've got the desire to potentially use ammonia or hydrogen, but just the delta between the density, the energy density, and how much incremental volume you need for that sort of a fuel source makes it really challenging to transport or to be I guess the primary mode
Yeah, and
of
like I think
propulsion.
LNG it's really unique, and maybe I'll go into a deep dive on the LNG for those that care, and just because I've got the microphone and nobody else is chiming in, so
Go for it.
so most of you are familiar with propane, right? You've got your propane sitting in a tank under your barbecue. One like cup full of that propane liquid, when it goes from a liquid to a vapor, it liberates out to 270 cupfuls of vapor. So that's its expansion ratio. Now, when we talk about LNG, which is methane, that methane's expansion ratio is a 600 to 1. So 1 cupful of liquefied natural gas liberates out to 600 cupfuls of that vapor. So from an energy density point of view, when you can liquefy this stuff, it is insanely valuable because it just compresses down into such a small volume, transporting it overseas. And that's where the huge market is transporting this LNG to places in the globe that are, taking in coal to for power generation to get the Asian market off of coal and to cleaner burning fuel, right? And I think that's where the LNG market, I think, is still a market that is going to continue to grow and will grow rapidly as we push towards this energy transition. And even just changing gears, I think I saw Siemens with their wind turbines. I think they just announced some. I just saw a headline briefly, but something about pretty big losses in terms of their sector is not performing as well as. Oh, there it is. Yeah, they face a $5 billion. So yeah, their turbines aren't doing as well as they thought because and I didn't go into too much of detail on it, but just interesting. As we push towards this green energy, there's lots of learning to happen.
Yeah, and people lose sight, thinking about natural gas. You get these. I just feel like you have a lot of people who purport to be very green oriented who don't really live in reality, and perhaps they live more in a utopian world in their heads. That they're like, oh, we don't want natural gas burning stoves. We don't want this or that. When your point that, well, it's really a transition from, say, a very high, a much higher emission fuel source like coal or biomass. People in India, burning wood as a power source, which is not good for the environment.
So yeah, funny anecdote. We've actually got a recent municipality. There's part of greening and reducing their fossil fuel consumption is they've removed their natural gas fired boilers to then put in biomass fired boilers. So they're burning wood product. So, but it's all under the umbrella of reducing fossil fuel consumption, but not truly reducing greenhouse gas emissions, right? Because when you burn wood, you're still producing carbon, right? So it's very interesting as we, people making policy decisions, all this sort of stuff is happening, but it's not with logic, and that even the same thing with the EV, if your power grid isn't 100% green that you're plugging your EV into, your EV is not green. Yeah,
sure. If you're living in Wyoming, which is predominantly fueled by coal, and you are driving a Model 3, you might want to reconsider. It would probably be more efficient actually for you to be running a hybrid in that, if you're truly intent on minimizing your total carbon footprint. But
for sure,
it's
right?
a very nuanced discussion, and people prefer to paint in very broad strokes on it.
Yeah, I saw a graphic I think I shared in the Discord a while back, but just in regards to the end tailpipe emissions of EV versus gas, and it's not as great as you'd hope, just because it is you have to take that into account for where the power is being generated. But West Coast, where it doesn't get, that cold typically, green electricity is a bit easier to manage, right? But
you guys in the Pacific Northwest are also blessed with a lot of hydropower. That's obviously very clean, right?
Yeah. In our province, I think 98% of our electricity is hydroelectric. And then it's, backed up with, funny enough, natural gas. So if if certain things go down, natural gas is the backup energy supply. Yeah, that's the graphic there that you're showing in the Discord that I.
Life cycle emissions of EV versus combustion. So you have emissions that are higher in the manufacturing process. So from the battery manufacturing compared to the total emissions generated in manufacturing a internal combustion vehicle, it's higher. Of course, you're going to get that payback over time, again, depending on your fuel source or as you operate the vehicle. And that's where it's always going to vary based on where you're located, where you're operating the vehicle. You've probably heard me say it before, and Joe and I, in our team meeting last night, we were kind of reviewing some of this stuff, and I was talking about how Toyota, right, for a long time has been oriented around, well, we can have a lot more of an impact if we say made all ICE vehicles hybrids and spread our limited, for now, lithium resources across, putting a couple kilowatt hours in all of the vehicles, adding different mild hybridization, all the stop start with the 48 volt systems, allowing if you're in city driving to have that regen capacity, if you're in low speed driving, not turning the engine on, yada yada yada. How their view has been, and of course they're an incumbent player, so it makes sense that would be their view to an extent, but their view is it would be much more effective of achieving, if the goal is truly to be reducing emissions, life cycle emissions, to kind of shift the fleet from pure ICE to kind of all hybrid, at least on the route to when supplies of the other materials no longer become as constrained, perhaps later this decade into the next. But yeah, it's a very multifaceted discussion for sure.
Yeah, it makes for a good way to make enemies at parties. Yeah, I usually get a smack every once in a while when I start talking about this stuff from my wife, and she's like, "Shut up! We want actually these people to hang out with us again."
Or on basis, right? Especially now, it's the moment you talk about energy and how EVs and batteries are overhyped, and the real benefit is less than the perceived benefit. There's a group of people that just jump into the space to defend Elon's wealth.
And we have to always think about when people are, whether it's Elon or it's Mr. Toyota or anyone, they're looking for themselves first. And in Elon's case, having more government funding flow into the space helps him and Tesla. It's I think people perhaps sometimes are willing to just assume that it's all I don't know, rainbows and butterflies, and it's just not. I've driven plug-in hybrids for most of the last decade. I actually, as a user, and like I said when we were having the discussion earlier about the video that I shared in the Discord on the from NACFE, kind of highlighting that PepsiCo facility in California that's been utilizing the semi. There's actually a lot of pros for the driver. If you think about people, professional truck drivers who spend their day inside the vehicle, the overall experience for drivers, and I haven't been at Ryder now for over a year and a half, but when I was there, and it was very early days, it was very consistent though that the drivers, once you have this notion in your head that drivers are very resistant to change, they're very old fashioned. I don't ever want to drive an electric truck, but once they get in it, they actually typically love it. They don't want to there's only so many of them. They don't want to let somebody else be the one who gets that truck on a daily basis. It's a better driving experience all in. It's hard to argue that electric motors aren't more effective than diesel engines and gasoline engines at low speed. And we've had this discussion on this space, right? If Elon had been serious about commercial vehicle electrification, there would be a Tesla step van product. There would be a Tesla van that would have come to market before Rivian that would have fit that duty cycle. They would have outfitted all of UPS, FedEx, USPS's fleet, because that is a use case where you can make an economic case even in the absence of a lot of these hefty subsidies, because when you're in a stop-start application, diesel engines don't like that. You're consuming a lot more fuel, if you're just idling, right? Whereas if you have the electric motor, you're not consuming hardly any energy at idle. And for those sort of applications where you can then go bring the step van back to your depot at the end of the night and plug it in. Again, I was talking about earlier how for these if you're talking about big rigs, you're talking about a multi-year investment just to make the facility ready to handle. If you were, say, a garbage truck hauling company, if you're Republic Services, it may not even be feasible to fully electrify your fleet, depending on how many trucks you have in that particular depot, because you're talking about adding massive amounts of energy coming into the site for level 3 charging for these big trucks. If you're talking about only needing a level 2 charger for these step vans, UPS has been doing this for years now in the United Kingdom, and you can let software manage that for you, where it knows that this truck's routing tomorrow is only going to require this much, so therefore it can pause that truck's charging, and it'll still have adequate supply. It goes back to what I keep saying, that at an overall system level, it becomes more complicated to manage a fleet of electric vehicles, even if the vehicle itself is simpler.
I think if Elon was truly serious about that commercial space, though, which is clear that he's not, because you don't make money, you don't make the same recurring user purchases in a commercial vehicle, right? You don't, commercial's not buying self-driving software, and because very few cars, except now Tesla vehicles, have a recurring revenue chain, right? They can release new software, and then people can then purchase that new software. And my 2003 Mini Cooper, I can't purchase any software for it, right? It was paid for once, and BMW makes no money on it, whereas Tesla makes money on these vehicles anytime they release new software. Anytime that vehicle changes hands, stuff has to be unlocked and paid for. Where the commercial vehicles, yes, they're higher,
Scott, because pretty soon there's going to be a monthly charge if you want heated seats. But I mean, look,
but that's what I'm getting.
Broken down that barrier for the other OEMs. If consumers are willing to pay, why would the OE not sell this high margin software offering? You're going to get more powerful air conditioning if you pay $9.99 a month. You're going to get this, that.
Do you want 200-watt heaters or 300-watt heaters? We'll just it's that the race to the bottom and death by 1,000 subscriptions, right? And people think, oh, I got this great $60,000 Tesla, but it's like, what is your you're spending probably the equivalent that I might spend to commute, but you're spending it on subscriptions for full self-driving, or all these sorts of things. So it's cost of ownership isn't actually that much cheaper, and it makes a great business case to have a computer on wheels that continually needs software upgrades. And if they come out with a new software, whatever it is, that the majority of Tesla owners will purchase it. But will UPS or USPS, if they had a Tesla fleet? No, they're going to say, well, We don't care about our drivers needing, you know, full self-driving. We're paying them to drive. We want them to drive, or, you know, however it looks, right? So it's that, I think, yeah, they missed a boat, Tesla, and I think, but they didn't miss a boat from making money, and I think that's their goal.
Hey, Chris, did you want to chime in on this topic?
Oh, hey, Rod. Can you hear me?
Mm-hmm.
Oh, okay, yeah. Um, I mean, I guess I think we've talked about this before in another space, but I remember there was like recently, a few weeks ago, I think a few months ago, there was like a hearing in the California State Assembly, and they passed like a law saying like trucks, like long haul trucks, had to be electrified by like 2030, I think. Correct me if I'm wrong. Um, and this guy that was in the industry would basically had to go up there and testify, and he was like, this is not possible. Like, you need power like of a whole city just to fuel a few trucks.
Yeah.
And we just don't have that right now. And I think it would be very good if politicians learn how the energy industry worked, how transportation works, and the actual demands when they want to make policy, rather than just like focus on, oh, we need to stop climate change. Sure, that's great, but we need to very accurately draw the path out there and not just like spitball, hey, let's just
Right. So
pick a year.
California Air Resources Board had been working on this advanced clean fleet rule for years, which the state approved toward the end of April. So it's been a few months, which is in line with what you were saying, that over a staggered period of time across different commercial vehicle types, there will be higher and higher hurdles of zero emission mix of fleet sales, which that's, I don't think it's a very realistic policy in terms of there just simply won't be the production capacity to meet the mandates. When I was at Ryder, for example, because of California's onerous rules on engines, Cummins, for example, I think they're the largest engine maker in the world, and I know they are, at least in North America. But Cummins was basically, by regulation, being forced not to sell some of their diesel straight trucks, or the diesel engines in straight trucks in California because of these rules. Instead, they were going to sell big gasoline engines, which are much less reliable than diesel engines. They have a lower life cycle than diesel engines. So it's like you have these draconian rules from regulators that look to get, we want X, therefore you must do this. And, it's just not a very realistic way of going about things. But the state of California can mandate what it wants. But when you think about, okay, so what does that do? Well, if it's a sales related rule, will it just mean that the state of California no longer sees any truck sales, and instead you just see Oregon and Nevada and Arizona have a lot more truck sales that are then exported into California? Like, you have these very perverse incentives that these very strict regulatory regimes create. And I'm not very optimistic about the state of California's regulatory regime being grounded in reality, but it's the world we live in. And look, it goes back to a very key crux of the entire thesis that full fleet electrification could happen, is that battery cost curve will continue to trend downward. And it's not entirely clear to me that that's going to continue. I'm sure some of you listening who do know this stuff are aware of it. Bloomberg New Energy Finance, BNEF, does an annual battery pack cost survey, and in 22, the price of the volume weighted average price for lithium ion battery packs rose by 7% from $141 to $151. Now, if you see my screen, if you've seen this chart, I'm sure you've seen it before somewhere, this wonderful chart showing over the last decade, this decade and a half now, how much the price of battery packs, the cells, the modules, the full-on pack have come down over the last decade and a half. The challenge to me, though, is that the projections show this cost getting really small. Now, there's a whole new variable, of course, that entered the mix a year ago in terms of the Inflation Reduction Act, which is offering $35 per kilowatt hour on the cell side, another 10, I think, on the module side, so like 45 all in dollars per kilowatt hour of uncapped tax credit from the United States government to the manufacturers of those. So I mean, that's a huge number. If in 22 you were at 151 fully loaded, and now you're basically seeing a third of that cost eliminated by the state through these credits that are going to cost many hundreds of billions of dollars to taxpayers, which, if the truth were that engineering gains, scale, process improvement in manufacturing were going to get you to where you needed to be, where the math were irrefutable, that X subsidies commercial electric vehicle or just any electric vehicle will have a lower cost of ownership than the internal combustion vehicle. It was just very muddied by all of the regulatory, and I would stand by the line of thinking that X incentives, you're still not there in terms of it making sense in many applications. It makes sense in some, but we also can't ignore the amount of money that the inaptly named Inflation Reduction Act is pouring into this space, which I know, Scott, you've obviously been close with from kind of your interest in Recyclico, but the rate of change of the improvement in cost, the fact that it really appears to have gotten toward the low point is worrisome to me. I mean, if you ask people, you get a different answer depending on who you ask and depending on whose projection you look at and what the fully loaded costs. BNEF, for example, still predicts that the average pack prices would fall below $100 per kilowatt hour by 2026. But they note this is 2 years later than previously expected and will negatively impact the ability for automakers to produce and sell mass market EVs in areas without subsidies or other forms of support. High battery prices could also hurt the economics of energy storage projects. Will, of course, then enter the mix the IRA's helicopter money, which will help the economics of all of those things. But the worry for me as an investor, as trying to make long-term investments in this stuff, is what happens if in 2024 you have a Republican sweep, they dismantle this bill, and now you have billions of dollars of stranded investment. A lot of these companies would be just utterly wiped and zeroed out if the bill were dismantled. So there's just a lot of regulatory risk then if you're hanging your hat on policy that could change overnight, that is pouring many billions of dollars into this sort of an industry. So it's really complicated, no matter how you slice it.
I think one thing too that graph shows is, yes, the price is coming down because we're supply and whatnot, but what it's not taking into account, I don't think, is the increase in adoption it's that demand piece, right? So yes, our forecasted price is going to drop, but as we continue to now lock up materials and materials get more expensive to get out of the ground, and the demand increases rapidly, you may see that price start squeaking up again, right? Because it's not easy to come around some of these materials that are critical, right?
So, Rod, to your point, I would think of it differently. Think of this as any thematic investing. Right now, where is the money being made? Where is the revenue coming in today? That's the only part of the theme that matters. You don't invest in Ford sustaining, cost advantages, assuming this Inflation Reduction Act stays in place through multiple administration changes. But you invest in a ACOM or an engineering company that's building that factory for them, and they're getting that money and walking away with that revenue forever, right? That's it. They're done. They got their piece of business. They've
Yeah, they don't have to
they've
worry
moved
about the
on.
profitability of the manufacturing site. They just have to get the money to design it and build it.
Correct. Right. That's exactly how you see this. This is not just this. It's any thematic, right? Whether it's AI or this or cybersecurity or anything like that. You look at where the money is today, and that's where your investment should go, not where the money is going to accrue day after tomorrow. Yeah, worry about that day after tomorrow or tomorrow before that. When you're certain that the trend is holding, right? Remember, we talked about this in terms of Microsoft and its actual revenue stream from AI. This is exactly the same thing. That's how I would look at any thematic.
That's a really good point. Yeah, appreciate that.
And at least right now, clearly there's a lot of money going into building up the necessary manufacturing to meet what this bill has wrought. I don't have the graphic in front of me, but oh man, there was a really good one that broke out kind of all of the private investment spend, and it really highlighted how it was just a handful of sectors, the ones that are the money recipients that are seeing these huge upticks, have seen over the last year-ish in investment. So yeah, you're right. You don't necessarily need to try and invest in the end state. Invest in where I guess the picks and shovels providers, in this case, almost literally, uh, who are going to get their money and who aren't going to be, at a whim of what may end up not being a profitable market at the end of the day. Because the automotive space, again, it's historically not been a great space to invest in and see good returns on invested capital. And while Tesla has to date proven the naysayers wrong, so to speak, um, that doesn't necessarily mean it continues into the future when there's clearly a big uptick in competitive offerings. And you know, I still think that there's a lot of interesting stuff in the sectors that are kind of viewed as like left behind. And talked about Allison Transmission before. Talked about, I think I mentioned I made an investment in my personal account in Garrett Motion recently. A maker of turbochargers, and a lot of these not sexy players who are not the new, and improved, so to speak, uh, who provide very valuable, like an Allison transmission makes work more efficient. If you have a fleet of 10 straight trucks and they're outfitted with manual transmissions, you could probably get by with 9 or 8 if they were outfitted with the Allison. So like there's stuff in the boring old economy that, as like EV has overshadowed everything the last few years, some of those old economy companies got really beaten down, and they're very profitable. And of course, people look to the future and say, well, maybe they won't be needed 5, 10, 15, whatever years from now. But I, from what I continue to, even after leaving the industry here, is that the expected adoption on the commercial side only continues to get elongated. No pun intended, Elon. So players like Allison, legacy players in the supply chain, probably have a longer shelf life than people think.
Yep. Hey Rod, I sent a DM to your personal account. That's the S&P industrial performance by industry in the last 1 year. Construction and engineering, 42% last 1 year. This is exactly the point I was making.
Oh, yeah, within industrials, yep. Machinery, not too far behind. Electrical equipment, building products, yep. All the stuff that, yeah, it makes a lot of sense. Those are beneficiaries of these chips infrastructure IRA. Yeah, thank you. I've got to think rail, um, you know, longer term, maybe not near term, but like as you keep putting more manufacturing in North America or Central America, that rail is a long-term beneficiary of the increased demand for freight movement at lower emission per mile, lower cost per mile. Um, I don't have any rail investments today, but that's a space that has made a lot of people a lot of money over the last century.
And they've been relative underperformers the last few months, so might be a good time to pick up a little bit.
And I know your favorite aerospace and defense is also not moved much in the last year. So
Yeah.
it's just math, right? If you've gone up a lot, your forward returns will, by just the nature of math, likely be lower. And if you've been flat or gone down, your forward returns will probably be higher, all else equal. Good stuff, guys.
Rod,
Yeah,
do you mind if I change the topic a little bit?
yeah, go for it. So figure 20-minute
Oh,
warning.
just a
But
yeah,
yeah,
20-minute
please go
warning.
ahead.
Okay, yeah, I just got the news, just got out a few minutes ago, that a judge for the Delaware Court of Chancery approved the APE AMC merger um,
Oh,
down in meme stock land. So
so this was the
AMC is down
revision,
about
right?
30.
They just had to change
Yeah,
the language only a little bit. Wasn't that what had to transpire? So that got approved now?
the settlement was approved, so the judge basically gave the go ahead for the merger
APE is
to
up
happen as soon as
25%
possible.
after hours. AMC is down 26% after hours.
Um, so it seems like they'll be able to raise capital pretty soon. I don't know how much they can raise. They don't have much time.
Well, but hang on though, because AMC still has to get the shareholder approval to authorize additional common issuance, no? Or was that, oh,
I
is that being approved as part of that's right, because the ape tokens had the
They
vote.
can issue as much APE as they want.
Ay, ay, ay.
Yeah.
Right, because they created ape to get around that share, the authorized share limit, because um, they had come up, they had butted up on what they were limited by their bylaws or their articles of incorporation, whatever. And yeah, well, guess we'll see.
Yeah. This was a very long thing. That lawsuit kind of delayed things and allowed, some opportunists to take profits. Confused the hell out of a lot of people who are much smarter than me. But yeah, finally it's over, I guess. I hope it's over.
Well, Chris, no, it's not over. Ape's never leaving.
Yeah.
It being
Yeah, look,
that they'll now be able to let the vote move forward. So AMC, the Bloomberg reporting states it wasn't immediately clear when the APE conversion would take place, but AMC officials have said they hope to raise new financing by the middle of the month. So
Oh, nice.
they'll be able to
That's pretty soon then.
dilute common shareholders in short order. And it's like it's a complicated discussion because the company must sell equity to raise capital to continue as a going concern. I mean, I still don't see a way for equity investors to get a return on their investment in this token. But if they're able to sell enough equity, there could be interesting ways to get returns in the credit side. If you want to invest in AMC credit, because if they're able to keep selling shares, if self-styled apes are willing to keep buying the common stock, right? And they can keep raising capital through equity sales, then the credit situation gets better and they can pay their bills and maybe creditors get a good return. I don't own any. I have no position.
Yeah.
Just pointing that out.
Yeah, I think if they can knock out a few $100 million off of their debt, that's still a pretty big chunk. It's still, they have a lot more debt, but if the movie business keeps picking up, people start going back, you get to pre-pandemic levels, maybe it is feasible that creditors would get a return here. The bonds now are getting, I think, like these 26 notes are 40 cents on the dollar, yielding 5.8, 5.9.
Well, a good weekend for the arbitrageurs who've had a very rough go at it. It's been a very, very unpleasant ride for anyone who was betting on the convergence of APE and AMC and paying that borrow, shorting the common, long the token.
Yeah. It's been a rough ride. But yeah, that's a good deal of carry. I mean, if you look at from like October, right, of last year, or even like slightly before in September, all the way to now, the price is basically the same on these bonds. And you're just picking up this current yield of, what is the current yield? 5.8 divided 5.875 divided by like 15%, right?
Well, I know, and I think we talked about it the other week, that people who were long the AMC common and lending were getting rates at Interactive Brokers of like 1,000% borrow over the last month. So, you don't even have to worry about holding the common for all that long if you're getting paid that much and to lend it out.
Yeah.
But this, the rates should fall through the floor though on this news. Borrow rates.
But I mean, that's a very risky position, right? Because this arbitrage could have closed at any moment.
Oh yeah, of course, and definitely not risk-free.
Like,
don't interpret it as risk-free.
Yeah,
that's not what we're saying.
High yield since last year has been a very good trade. It's done very well. I mean, not as good as like levered, beta, but like they've been able to get a really good return. All these, junk, bond investors. Technically it's a safer bet, right? Because they're going to dilute. So, but yeah, that doesn't always work.
This was a pretty quick turnaround, though. It was only 3 weeks that it took for them to get this revised deal approved.
Yeah.
Rodney.
Yeah.
My legal first name, as a matter of fact, is Rod.
It's not Rodney?
It is not.
Bro, you were on the cover of New York Times?
I was.
Are you fucking kidding me?
January 21 was a wild time.
Bro, I really don't know this story about you with GME. That's crazy, dude.
Feel free to listen to my Odd Lots podcast that was recorded.
So am I like the only guy in here that doesn't know this? How have I been around you all this time and missed this conversation so many times?
I don't really enjoy talking about myself. So.
This is the best cover of the New York Times ever.
Bro, legit, you too, bro. You're on there too.
It was Rod, myself, and Colin.
Awesome. I
Great
got the right kind of
trifecta,
buddies.
and then
I'm
the
in the
roaring
right
kitty.
spot. I'm at home. I feel better now.
I love it. Love it.
I miss Keith Gill. I wish he would return.
That's the sad part of this whole story is he had to really go into hiding. But he played that so well. I mean, otherwise there'd be so many people wondering what his next move was and following him on trades. And even just with GME when we transitioned out of only talking about GameStop, I can only imagine that the impact of that on him if he was to do that, if he was to start talking about other companies, which is what he'd want to do. Naturally, he'd want to talk about all equities. So he would deal with that same wrath of the cultists.
Well, congrats, guys. You learn something every day. Not always do you learn something that cool about somebody, but that's pretty impressive. So kudos to you guys.
If you have a Hulu subscription, you could check out the documentary Rise of the Players, which I agreed to participate in because it covered a lot of the folks who were part of the
Are you
Roaring Kitty
serious,
chats with me.
That's so funny. I'll watch that tonight. You said Rise of the Players?
Yeah.
Okay. Huh.
But I mean, like, just to tie this back, Wook Capital wouldn't exist were it not for the events that transpired. John, my CIO, John, and I with Joe, with a handful of other investors, we were crowdsourcing information. We put together our research report that we published that I had no way of knowing, within a week and a half of that, the stock would go up 10x plus. Our thesis for the firm is that we can achieve alpha through collectively sharing our knowledge, getting deep insights from people who might have unique expertise or awareness of certain industries or companies. That's all kind of enabled this to happen. So that's we don't do these just to run our mouths. Our hope is to deliver some value for people that choose to be part of our community, if you will, and of course, hopefully get value by the community members and what they have to share. Hopefully dig up some different nuggets of knowledge, as we say, and all that good stuff. Yeah, check out the doc. That was fun. And yeah, that should give you a little bit of a backstory. But anyways, I know we only have a few minutes left, so maybe we shouldn't switch topics. I don't know if there were any other things that anybody on the panel wanted to share before we wrap this afternoon. I will confess that I lied to my boss during that week in January when I told him I was sick and I couldn't go to, couldn't attend work January 27th or 28th and 29th of 21. I then at least told him the truth that, sorry, I was recording a podcast with Bloomberg and it was on Bloomberg TV. That's why I didn't work today, boss. Sorry. I was a little overwhelmed.
I'm sure he forgave you.
Yeah, he did. It's funny because I continued working there for almost a year, and when John came to me with the opportunity with regard to Wook, I was excited about it, and when I went to my boss, he was like, "Okay, I was waiting for this." He was like, "Yeah, I thought this was going to happen a while ago." Me leaving, but
yeah, not really hard to read the tea leaves on that one, I don't think.
Good times. very different world. 21.
Yeah. Well, we've all learned lots, and we appreciate all the work that you guys do. And yeah, thanks again for running these, Rod.
Yeah, thank you, Scott. Thank you, Monative. Thank you, as always, Chris, D-Bone. Appreciate everyone for chiming in on the speaker panel. Joe, maybe go through kind of some of the stuff that we do on a regular basis and what we have coming up next week.
Yeah, thank you guys for all tuning in. It's been a lovely discussion. We have next week the open mic hosted on at GMEDD, and then we also will be hosting the Wook in Review again here on the Wook in Review account. Hopefully soon. We'll try to merge all the programming into one account. But right now we're trying out a few different platforms, seeing what fosters the most productive discussion. It's not always about listener count. We try to always have engaging discussions where we can actually all, achieve alpha through these discussions. Pretty simple. But tune in next week, open mic on at GMEDD. We have the book club at the end of the month, and more information on that is on the at Wook Capital Twitter account.
Yeah, this month's book club. So we do these last Tuesday of every month. We're going to be shifting it into Discord stages as opposed to Twitter Spaces. It's a little, I think, more of an intimate place to discuss, a book that I think if you're on Twitter Spaces, random people tend to pop in who maybe haven't read the book and sidetrack the discussion. So we'll be doing that on Nassim Taleb's. Which one is it? Is it Fooled by Randomness? I think is this month.
Yep, Fooled by Randomness. I've got the book right here.
Yep. So that'll be last Tuesday of the month at 8 p.m. Eastern. Which again, if you're not in that Discord, you can access it through your browser. wook.gg will bring you to the GMEDD Discord rapidly, which despite the moniker, it's really discussion around all sectors, industries, stocks, and anyone's welcome. So awesome. I hope everyone enjoys their weekend. Stay cool out there. It is sweltering here in Florida, and we'll be back next week. So I'll catch you all then. And Monitive, you're taking a break now, right? Because we're kind of past earnings season.
Yep. I'll be back in September. Yep.
Okay. Because Monitive also runs some great programming. He'd been running them on Sundays, but once earnings season comes back into swing, we'll be back with those. And I know I've bothered him about it, and at some point in September as well, we'll have a kind of deep dive on aerospace and defense with Monative, and we'll wrangle some of the other experts who are here on the platform and try to have a really cool kind of discussion on that, because that's one of those sectors that it's not sexy. It's not something that's discussed too much, but there's a lot of money to be made, I think, and there's a lot of interesting opportunities there. So that'll be coming, and look forward to it. So thanks, everybody. As always, great discussion, and we'll talk soon. So cheers, everyone. Safe out there.
Peace.